Something extraordinary happened in the dead of night while silver traders slept. The metal had just shattered the $75 barrier, and mathematical projections painted an undeniable trajectory toward $100. But the celebration would be short-lived. Behind closed doors, exchange officials gathered with the titans of bullion banking for an emergency meeting that would change everything. They faced an impossible choice: accept catastrophic losses that would bankrupt their institutions or rewrite the rulebook mid-game. By 3:00 a.m., their decision materialized as a quiet posting on the exchange website. No press release, no social media announcement, just a regulatory bomb dropped in the darkness, designed to detonate when the markets opened. What they implemented wasn't a routine adjustment. This was financial warfare disguised as policy, an unprecedented margin requirement hike that would force winning traders to liquidate their positions or face immediate consequences. The referee hadn't just been bribed. The referee was now actively playing for the losing team. Understanding what happened requires grasping how margin actually works in futures trading. When you enter a silver contract on the COMEX, you're utilizing leverage to control substantial quantities of metal with a relatively modest cash deposit. Perhaps you commit $10,000 to command a position worth far more. This arrangement functions smoothly until the established powers begin hemorrhaging money. Then the machinery of control kicks into overdrive. The rule change that emerged from that midnight session effectively doubled the cash requirement to maintain existing positions. Picture this scenario. You've purchased a home, signed all the contracts, moved your belongings inside, and then your lender calls the following morning with an ultimatum. Pay an additional $50,000 in cash within hours, or we're seizing the property and selling it immediately. This isn't hypothetical fiction. This exact nightmare is unfolding for thousands of traders right now. They're receiving margin calls not because their positions deteriorated, not because the market moved against them, but purely because the gatekeepers unilaterally changed the terms of engagement. The exchange is manufacturing a forced liquidation event to generate artificial selling pressure, all to rescue J.P. Morgan from the brink of insolvency. But cranking up margin requirements proved insufficient to halt the momentum. Intelligence is flowing in from multiple brokerage platforms reporting that buy functionality is being systematically disabled or restricted. We've seen this playbook before with GameStop. Traders attempting to initiate new silver contracts encounter cryptic error messages. Risk management limits reached. Trading restricted to liquidation only. Translation: you're permitted to sell your silver to the banks at distressed prices, but you're prohibited from acquiring more. When the buy button disappears while the sell button remains active, price movement becomes unidirectional, downward. This isn't market dynamics. This is controlled demolition. They're artificially constraining demand to enable banks to cover their naked short positions at bargain basement prices. Market manipulation doesn't get more textbook than this. While retail investors face buying restrictions, institutional algorithms are being unleashed to paint a fraudulent picture of market conditions. This morning brought the appearance of massive sell walls on the order book. Blocks representing 5 million ounces materialized at $76, designed to terrorize market participants. Here's the twist: these orders are phantom constructs. The practice is called spoofing. Banks place enormous sell orders to pressure prices downward, then cancel them milliseconds before execution. No actual silver changes hands. They're not selling. They're manufacturing the illusion of overwhelming supply. They're gaslighting the entire market, attempting to convince participants that everyone is bailing out when the opposite is true. Everyone wants to buy. This is psychological warfare engineered to shake out weak hands. We need to examine the role of the COMEX itself in this corruption. The exchange is theoretically a neutral arbiter, ensuring fair competition and transparent price discovery. But the COMEX is owned by the very banks it's supposed to regulate. Board members are former executives from J.P. Morgan and Goldman Sachs. When they declare rule changes, they're not protecting market integrity. They're protecting their inner circle. By raising margins and imposing position restrictions, the exchange has violated its fiduciary obligation to public markets. They've demonstrated conclusively that the paper market isn't about price discovery. It's a casino that kicks you out when you start winning too consistently. The legitimacy of the COMEX died at 3:00 a.m. They've sacrificed their institutional reputation to preserve the solvency of the cartel. History provides a chilling parallel. In 1980, the Hunt brothers successfully cornered the silver market, driving prices to $50 and pushing banks toward complete collapse. The exchange response: they invented Silver Rule 7, which dictated that traders could only sell, never buy. The price imploded from $50 to $10 within weeks. The banks are executing the identical playbook today. They believe it will work again. But there's a fundamental difference this time. In 1980, demand was purely speculative. Today, demand is industrial. You cannot tell Apple or Tesla that they're restricted to liquidation only. These companies require physical metal to manufacture products. The rule changes might frighten speculators, but they cannot halt industrial consumption. The banks are waging war against physics, and physics is undefeated. The most damning evidence of manipulation is the widening spread between paper prices and physical prices. While banks manipulate the digital numbers on your screen, reality tells a starkly different story. Attempt to purchase a physical 100-ounce bar today, and dealers are charging premiums of 40% to 50% above spot price. Why? Because spot price is fiction. The paper price is a lie agreed upon by thieves. The real price is what you actually pay to receive metal in hand. This disconnect proves the COMEX has become irrelevant. Banks can smash the paper price to zero if they choose, but they cannot conjure silver into your vault. The market has bifurcated into two distinct realities: the banker's price and the people's price. Traders need awareness of the next escalation. Buried deep within exchange user agreements is a clause labeled force majeure. This provision allows the exchange to void contracts during declared emergencies. If silver prices continue rising despite their manipulation, they will likely invoke force majeure. Their message will be simple: we cannot deliver the silver because none remains. Here's a cash settlement based on yesterday's artificially suppressed price. This is legalized theft. It transforms your property rights into worthless paper claims. They're constructing the legal framework to default on their obligations. They know the vaults are depleted, and they're writing rules to absolve themselves of liability when the bank run begins. Where is the outrage? Where are the investigations? Turn on financial news and you'll hear nothing but silence. CNBC, Bloomberg, the Wall Street Journal are ignoring what may be the biggest story in modern finance. They're not covering the margin hikes. They're not reporting on the shortage. Instead, they're publishing hit pieces dismissing silver as a meme stock and dangerous bubble. This coordinated media blackout is purchased with advertising dollars. The banks are the largest advertisers on these networks. They're controlling the narrative to keep the public uninformed. They want you to believe the price drop is natural market action, not engineered manipulation. They're suppressing the truth as aggressively as they're suppressing the price. Why are they taking such extreme risks? Why court prison sentences and public revolution? Because JP Morgan is trapped. They hold the largest short position in commodities market history. If silver reaches $100, the losses on their balance sheet will exceed their Tier 1 capital requirements. In plain language, they become insolvent. The entire bank could fail. This is why regulators are permitting them to cheat. The Federal Reserve understands that JP Morgan's collapse would trigger a systemic banking crisis. They've deemed JP Morgan too big to fail and issued them a license to rig markets for survival. We're not fighting a bank. We're fighting the combined power of the state and the financial elite. However, there's one player who doesn't follow American rules: China. The Shanghai Gold Exchange operates outside COMEX jurisdiction. China observes this manipulation and interprets it as weakness. When the West suppresses prices, China accelerates purchasing. They're exploiting the artificially low price to drain the West of remaining strategic reserves. The Chinese government is actively encouraging its citizens to buy gold and silver. They're accumulating metal while the West trades paper fantasies. Through their cheating, American banks are inadvertently transferring the keys to the future global economy to the East. They're selling their birthright for temporary relief. The rule changes are also enraging industrial giants. Companies like Samsung, Tesla, and Sony depend on futures markets to hedge costs. When the exchange rigs the market, it destroys these companies' ability to plan strategically. We're hearing rumors that major industrial buyers are abandoning the COMEX and establishing direct supply agreements with miners. This is the death knell for the exchange. If industrial users exit, the COMEX becomes nothing more than a gambling parlor for paper speculators. The physical market is migrating away from New York, leaving bankers trading phantom contracts among themselves. The banks made a critical miscalculation. They assumed that crashing the price and rewriting the rules would frighten retail investors into submission. They thought you would panic and capitulate. Instead, they've made you furious. Forums and social media channels are erupting with rage. Investors aren't selling. They're doubling down. They're withdrawing money from the system and buying physical metal to punish the banks. This is no longer merely a trade. It's a movement. It's a financial revolution. Every time they cheat, they validate our thesis. They're radicalizing an entire generation of investors who will never trust fiat currency again. The banks want you to believe they're omnipotent. They want you to believe they control price discovery. But their actions today, the frantic rule changes, the margin hikes, the spoofing, these aren't the behaviors of a powerful entity. These are the desperate actions of a cornered animal. A strong man doesn't need to cheat to win. The fact that they're cheating so brazenly is the ultimate signal of weakness. It means they've lost control of market fundamentals. They're attempting to hold back the tide with a broom. They can delay the inevitable, but they cannot stop it. The dam is fracturing and they're running out of fingers to plug the holes. What we're witnessing is the destruction of the free market concept itself. If rules can be arbitrarily changed whenever billionaires face losses, then there is no market. There's only a rigged game. This creates moral hazard on a catastrophic scale. It signals to banks that they can take massive reckless risks, and if those bets fail, the rules will be rewritten to bail them out. But this destroys faith in the system, and faith is the only thing supporting the US dollar. By rigging the silver market, they're undermining the credibility of the entire American economy. They're burning down the village to save the castle. Despite the paper manipulation, the supply crisis is intensifying by the hour. Mines are depleting, ore grades are falling. No major new mines have been discovered in a decade. We're consuming silver faster than we can extract it. Above-ground stockpiles have vanished. We're now depleting strategic reserves. Banks can print paper contracts until they exhaust their ink supply, but they cannot print geology. The fundamental deficit is real and growing. Eventually, manufacturing demand will overwhelm paper manipulation. When a factory must shut down production lines because it lacks silver, the price will go vertical, regardless of what COMEX rules dictate. Much of the short selling is occurring in the shadow banking system, the over-the-counter OTC market. These trades aren't reported to the public. This is where the real leverage is concealed. We believe the true short position is 5 to 10 times larger than official figures. This hidden debt is a ticking time bomb. As interest rates rise and silver prices climb, the cost of carrying these dark positions is becoming unbearable. We're approaching a Minsky moment for the bullion banks, a sudden violent collapse of asset values caused by excessive hidden leverage. Despite their manipulation, the wealth transfer is still occurring. Every ounce of physical silver you acquire today is an ounce the banks cannot use to cover their shorts. You're removing collateral from the system. They're trying to shake you out because they need your silver. Don't give it to them. The volatility is the price of admission. The cheating is the confirmation of victory. We're in the final rounds of a heavyweight championship fight. The opponent is dirty, hitting below the belt, but he's exhausted. He's wobbling. One more push, one more surge of buying, and he goes down. So how does this end? It ends with the failure of the exchange. It ends with physical silver prices decoupling completely from paper prices. We'll witness a black market price for silver that's double or triple the official price. Eventually, the official price will be forced to chase the real price. The gap will close violently and suddenly. The banks will receive bailouts from the Fed. The currency will be debased to finance it, and holders of physical metal will be the only ones left standing with preserved purchasing power. The manipulation isn't a sign that the squeeze is over. It's confirmation that the squeeze is entering its terminal phase. They're changing rules because they're losing. They've halted trading because they're terrified. They want you to sell. They want you to surrender, but you know the truth. You've seen the empty vaults. You've seen the mathematics. The system is broken and silver represents truth. Don't let them steal your future with a rule change. Hold the line. Demand delivery. Empty the vaults. The era of market manipulation is ending, and the era of the people is beginning.